Welcome back. Time now to build a portfolio harnessing the unique valuation technique of the incomparable Roger Montgomery with the legendary caution of long-term investor, moi. That's French for me. My producer wasn't sure about that. We're not only going to give you a list of top stocks, we're going to check up on them from time to time to see how they're actually performing. So get your pens at the ready. Now, Roger, great to see you.
Nice to be here again, Peter.
Now, this is a special occasion.
I know. I got your email and I thought, wow, okay, this will be good fun.
2 sessions.
Yeah.
An important session too, because, as I always say, the Montgomery valuation method, quite unique, even though it comes from Benjamin Graham and
Buffett and Walter and all those guys.
It's been tweaked for your experience on the market and all that sort of stuff. And a lot of this, of course, is contained in that wonderful book of yours, which is called
Value.able. It's a great book.
Value.able.
Yeah, look, it's gone. I'm really delighted that the feedback I've got's been really, really good. Yeah. People love it. I was at a fund manager's office today. This particular fund manager bought half a dozen copies for his staff and his family. He loved it. He said he gave it to one of his PhD guys in the firm.
You need a PhD to understand it.
No, you don't. That's the point. You don't. And apparently this particular individual was fascinated. So I'm really pleased that it's going so well.
I'm happy to promote it because eventually I'm going to write...
Have you read your copy? Have you read yours? Did you like it?
Yeah, I'm going to write... Of course I did. But I'm going to write Roger Montgomery for Dummies, and that's going to be real. I'll sell a fortune.
Oh, good. Okay, well, I'll help you out with that.
All right, mate. Now, the request I made was, give us some really good companies, if you can, where the intrinsic value is greater than the share price that's on the market, so therefore it's a great buy. But more importantly, because a lot of self-managed super fund in particular like to have stocks that pay good dividends, because as you know, at least half of returns from stocks come from dividends.
Yes.
So if we marry your valuation techniques to the conservative approach of dividends, I thought this should unearth some really interesting stocks.
Well, the traditional response you would get from most analysts and most fund managers would, they'd go back to their computer screens after you made the request and they'd go and find the highest dividend yielding stocks and they'd say, okay, well, these are the ones that have got good dividends. Well, I actually believe that that's a mistake, because several years ago you could have bought Qantas shares on a high dividend yield, and then they suspended their dividend. Telstra had a high dividend yield when it was at $3.60 and $3.70. It's now $1 lower than that.
There's even a higher dividend yield now.
Well, it's got a higher dividend yield, but a lower price. So you've more than lost. You've lost more than the dividends that you gained from the loss in the capital value. So it's really important, I think, instead of doing that conventional approach, I think it makes a lot more sense to actually buy really great businesses that generate high rates of return on equity, plenty of cash, their intrinsic value is rising a lot, and what you'll find is over time, one or two things will happen. Either they'll continue to retain profits and the share price will go up a lot because they're retaining it at high rates of return on equity, and if they do that, well, you can always sell a share here or sell a share there and you can get some income out of that. Well, the alternative, what they'll do is they're generating so much cash that they'll increase the payout ratio and they'll start paying out more as a dividend. So there's those as well. And then, of course, there's the companies that are on reasonably good dividend yields anyway. But I think the focus should be on good quality companies to begin with.
In a sense, that's what my thinking was. It's all very well to pick out historically great dividend-paying companies, but as you point out, if they go the way of Telstra or Qantas, it's sort of defeating the great principle. And so I thought the meeting of the great Roger Montgomery mind and the very cautious P. Switzer mind should produce some interesting results. Okay. So let's kick off.
Okay, well, what I've done now, I should couch what I'm about to say, that in the mandate that you gave me, so that the instructions that you gave me, I could only actually find 3 companies that were below their intrinsic value. I found a group of 10, but a bunch of them are a little bit higher than their intrinsic value at the moment. So, but they're within 10% of their intrinsic value. So if you were to fully invest in this portfolio, hypothetically, of course, because you've got to go out and get personal professional advice.
Of course.
But if you were to fully invest in this, the expectation would be that you're going to go up and down with the market, but over time you should do better than the market. So
and can I just throw in, given the fact that the market still is shackled by the fear that's going around at the moment,
Sure.
eventually when this fear goes, these companies are going to be well positioned to benefit from an inflated market price when people get excited again.
Well, when they get excited again, you'd expect the whole portfolio to go up.
Intrinsic value has already been established by you and your wonderful technique.
Thank you very much. What I'll do is I'll list the three that are on here. And remember that we previously had a conversation about blue chips. So I tried to stick to the bigger end of town here. And just for your show only, I've also put together a list of companies that are smaller that people might want to go and research as well, that are below intrinsic value.
Yeah.
Okay,
but they're still reasonable dividend payers.
Yes, well, some of them are. Yeah, we can rank them by dividend yield.
By the way, I should inform people, we're going to call this the Switzer Montgomery portfolio.
The Switzer Montgomery model, fine.
I thought you might have responded one up Montgomery Switzer.
The only problem is that
I just think it sounds better, Switzer Montgomery.
Look, I don't mind either way. I'm happy. If the time frames for a show like this are much shorter, people want to know next week and next month how that's going.
No, we're going to check this
over. It's not really
over.
relevant. We need to check it over years.
My contract lasts a long time. We'll check this monthly. How's that sound?
Monthly will be fun. If we can do it annually, even better.
Yeah.
Okay. All right. So the first one on the list, and a controversial one, BHP. Trading at a discount to its intrinsic value. Its intrinsic value that I've got at the moment is around the $42, $43 mark, and higher than that, depending on what assumptions you put in.
It's about 38-ish today, isn't it?
Yeah, $38.90. They're about $38, $39. Okay. So if you think that there's not going to be any hiccups in China, the iron ore price isn't going to halve, and there is some talk that the iron ore price could halve.
Yeah, sure it is. But go on.
That aside, then BHP is in the list. Yeah. The next one, and a discount, the next one's JB Hi-Fi. We've talked about that. Yeah.
I don't care if you do repeats. At the end of the day, right, we're going for a special portfolio here tonight. Right.
Okay, well, JB Hi-Fi, is trading at $21.50, close to $22.
How's it been doing lately? Because you've been talking
very well.
Yeah, usually when something's talked up on this show, it does well the next day, which I don't want to influence the market or anything, but I
worry about that. I really want all of your viewers to understand that this is about long-term investing, not about short-term trading.
Exactly right.
And I'm not predicting the share price here.